At 25, giving up $500 every month feels like a major sacrifice, not in some complicated, abstract way, but in the most practical and immediate sense. Rent is coming up. The car is overdue for an oil change. A close friend is getting married in April, and attending means showing up for 3 different events before the ceremony even begins. That $500 is not sitting idle, waiting to be assigned. In your mind, it already has a purpose before it ever reaches your bank account. That is the reality most people live in. Not destitute. Not affluent. Just committed. Every dollar has already been claimed before it arrives. You have heard that investing matters. At some point, you may have downloaded an app, stared at the screen, felt a quiet fear of making a costly mistake, and closed it again. The choices felt overwhelming, like being handed an exam for a class you never attended. Index funds. ETFs. Expense ratios. Dividend reinvestment. The terminology did not feel welcoming. It felt built for people who already understood the system. And, more often than not, for people who already had money. That is how much of the financial world is structured. Then something changed. A figure appeared in your feed. A long-term projection showing what happens when someone invests $500 every month for 30 years and earns a historically average market return. The result was staggering. Large enough to make you look twice. Large enough to trigger something deeper than surprise. A very particular kind of grief. The grief that comes from realizing time is the only asset you can never recover once it is gone. That realization is where this story begins. The first thing to understand is what $500 a month really represents before it becomes anything more. $500 each month equals $6,000 per year. That is less than what many Americans spend eating out over 12 months. It is less than a typical car payment multiplied across a year. It is roughly equal to what the average household spends annually on entertainment. The point is not to criticize any of those expenses. The point is that $500 is not theoretical. It is tangible. It already exists within an actual budget. And whether that money becomes invested capital or disappears into everyday consumption is a decision made once, then repeated automatically month after month until the choice compounds into a life-changing result. You decide to begin. Not because every detail is perfectly mapped out, but because you understand something with unusual clarity. Choosing not to start is also a decision. And that decision carries a cost. The cost of waiting is difficult to see. It does not appear as a charge on a statement. It does not arrive in the mail. It accumulates quietly in the widening gap between what you will eventually have and what you could have had. And by the time that gap becomes obvious, it may be impossible to close completely. So you create an automatic system. On the first day of each month, $250 is transferred into a Roth IRA. On the 15th, another $250 is sent to a brokerage account. The money is divided for reasons that will make more sense later. For now, what matters is that the system is in motion. The habit has structure. And structure will accomplish what motivation alone rarely can. 3 months pass. Nothing dramatic happens. The balance is slightly higher than the total amount you contributed. The market rose. The market fell. The overall result appears insignificant. This is where many people stop. Not because they lack discipline, but because the human mind struggles to stay committed when progress is slow and nearly invisible. We are wired to respond to clear signals, evidence that our actions are producing meaningful results. In the first year of steady investing, those signals are almost impossible to notice. The $500 you chose not to spend has quietly become $1,600 in an account. Meanwhile, the $500 you would have spent is gone entirely. Gone in a way that is both ordinary and irreversible. Nothing remains except the fading memory of whatever it purchased. That difference matters, even when it does not feel significant. The $1,600 in your account is working. The $500 you spent is not. For years, the contrast between those two outcomes may be nearly invisible. That is both the central difficulty and the extraordinary advantage of what you are doing. You leave the account untouched. This is more challenging than it sounds. A friend suggests a trip. A limited-time sale appears for something you have wanted. The car begins making a noise you have never heard before. Each event presents a plausible reason to stop, to delay, or to direct the money back toward its previous role. You do none of those things. You treat the transfer the same way you treat rent. It is not optional. It is not debated. It leaves your account on schedule, regardless of what else is happening. This choice, which seems almost insignificant in the third month, may become the most important financial decision you make in the next 10 years. 1 year passes. The account balance reaches approximately $6,400. The market produced an average return of about 7% during the year, a figure broadly aligned with the long-term inflation-adjusted performance of the S&P 500. That return added several $100s to the money you contributed. The total does not appear remarkable. What is remarkable, whether you recognize it yet or not, is the foundation you have established. A foundation is rarely exciting. Its purpose is to support everything that follows. During this first year, something else changed. You altered your relationship with $500. Before you began, $500 felt indispensable. Already assigned. Already gone. Now it feels different. It no longer feels like sacrifice. It feels like infrastructure. Your lifestyle adapted to a smaller spending number. This is the opposite of lifestyle inflation. And it is one of the most powerful financial adjustments an ordinary person can make. You reduced your spending to fit within a lower amount. And the reduction did not feel as painful as you expected. That shift may be more valuable than the $6,400 in the account. Money can be rebuilt if circumstances force you to start over. The habit of living below your means cannot be purchased. It must be constructed gradually, 1 month at a time, until it becomes your default setting. 3 years pass. The account balance grows to just over $21,000. Your perception of the number begins to change. It no longer feels like a savings account. It feels like a future income stream you have not fully met yet. The balance is now earning returns on previous returns. The $6,400 accumulated in the first year is compounding inside the larger total. The contributions from the second year are compounding. The contributions from the third year are compounding. Each layer of money grows at a different pace because each layer has been invested for a different length of time. This is what compound interest looks like in real life. Not a chart. Not a hypothetical projection. A real account with a real balance that begins to grow faster than the speed at which you are adding new money. You encounter a phrase that describes an important milestone. The crossover point. This is the moment when your investment gains in a single year exceed the amount you personally contribute. You have not reached it yet. At $21,000 earning 7% annually, the account generates roughly $1,470 over the course of a year. Your annual contribution remains $6,000. The gains are still smaller than the money you are adding. But the distance between those two numbers narrows every year. The account becomes larger. The annual returns become larger. Your contribution remains exactly the same. The mathematics are increasingly working in your favor. And they are accelerating. This is the part of compounding that is rarely explained clearly. It is not magic. It is arithmetic. But it is arithmetic that operates continuously in your favor, every day, without requiring any additional effort from you, so long as you do not interrupt the process. 5 years have passed. The account now holds approximately $42,000. Over that period, you personally contributed $30,000. The remaining $12,000 came from the market. That means your money produced $12,000 without requiring additional labor. No overtime. No second job. No side business. The only requirement was that you left the investment untouched. That figure deserves your attention. $12,000 created by consistency, time, and the underlying mathematics of invested capital growing within a productive economy. By this point, you notice another change, one that is less measurable, but equally significant. Your financial anxiety has not disappeared. It has evolved. You no longer worry when the account fluctuates because you have watched it rise and fall for 5 years, and each decline has eventually been followed by recovery. During the 4th year, the market fell 11% in a single quarter. You felt the decline in the way any investor does. But you did not sell. You did not pause the automatic transfers. You did nothing. And, for a long-term investor, doing nothing is often the correct response. The account recovered. And the lesson became permanent. You come to understand something many people grasp only intellectually. The market does not reward the investor who knows the most. It rewards the investor who remains invested the longest. Patience is a financial strategy. And patience compounds just as capital does. 10 years pass. The account balance exceeds $100,000 and approaches approximately $114,000. That 6-figure threshold carries psychological significance that is difficult to overstate. Below $100,000, the account can feel like an enlarged savings fund. Above $100,000, it begins to feel like a self-sustaining system. A system that continues operating independently of your day-to-day decisions. In a strong year, the account may generate more than $7,000 in returns. Your annual contribution remains $6,000. For the first time, the portfolio is producing more in a year than you are adding. The crossover point has arrived. From this moment forward, you are no longer the primary source of growth. Compounding has assumed that role. Your $500 monthly contribution still matters. You continue making it. But mathematically, the capital already invested is now working harder than the new money you contribute. This is the milestone financial educators often mention but rarely convey with sufficient weight. You have built something that functions without your constant involvement. Not completely. Not permanently. But structurally. The foundation is now carrying its own load. You think back to the version of yourself who was 3 months into the journey, staring at a $1,600 balance and wondering whether any of this would truly matter. You remember the vacations you postponed. The purchases you declined. The transfers that left your checking account on the 1st and 15th of every month with the same reliability as a utility payment. No single decision felt extraordinary. Taken together, they created more than $100,000. That is what discipline looks like in retrospect. From the outside, it appears substantial. From the inside, it feels almost uneventful. A habit. A routine. The action you take before everything else. 15 years pass. The account reaches approximately $200,000. You began with nothing more than a decision. The decision was not complex. It was not brilliant. It was simply this. Invest $500 every month automatically. Leave it alone. Place it in a low-cost index fund that tracks the broad U.S. stock market, such as funds linked to the S&P 500. Own thousands of companies through broad diversification. Rebalance occasionally if needed. That is the strategy. There is nothing proprietary about it. No hidden formula. No secret system. If there is a secret, it is this. You continued when the results were invisible. You continued when the results were modest. And you continued when market declines made the process uncomfortable. Over 15 years, you contributed $90,000 of your own money. The account is now worth $200,000. The market and the power of compounding have added $110,000. For the first time, more of the account comes from growth than from your direct contributions. Your money has now grown to more than twice the amount you personally contributed. And the relationship continues to change. By year 20, the market's contribution far exceeds your own. By year 30, you become a minority participant in the growth of your own portfolio. The majority of the expansion is generated by capital that is already working on your behalf. A younger colleague asks why you seem unusually calm about financial problems that unsettle everyone else. You struggle to explain it clearly. Eventually, you say that you have built a foundation. She nods, though it is obvious she does not fully understand. You remember what that felt like. You remember hearing similar explanations and sensing their truth without truly grasping them. Some lessons cannot be understood from the outside. They only become clear once you are living inside them. 20 years have passed. The account now holds approximately $312,000. The curve of growth has become unmistakably steep. Even someone with no financial background can see that the pace has accelerated. Over 2 decades, you contributed $120,000 of your own money. The account is worth $312,000. Compounding has added $192,000 to your net worth. That increase required no additional insight, no repeated decision-making, and no special expertise beyond the original choice you made at age 25. In an average year, the account now produces more than $21,000 in returns. That is more than many people earn in several months of full-time work. Yet it is generated quietly by a diversified index fund tracking the broad U.S. stock market, such as funds tied to the S&P 500. The account attracts little attention. It demands almost no maintenance. And it continues to grow. During these 20 years, you have also developed something the balance sheet does not record. You became someone who was no longer easily shaken by financial panic. When headlines warn of recessions, market crashes, and economic uncertainty, you observe them with the measured perspective of someone who has lived through multiple cycles. You understand that short-term volatility is not a flaw in the system. It is part of the system itself. This understanding did not come from reading about investing. It came from experiencing it with your own money at stake. Throughout the entire period, the $500 monthly contribution never changed. Your income increased. Your lifestyle improved gradually. But the $500 remained constant. Not because you were unable to invest more, but because this single habit was already performing the task it was designed to perform. Your raises funded your life. The $500 funded your future. That quiet division, maintained over 2 decades, became $312,000. 30 years pass. The account grows to approximately $567,000. Nearly $600,000 created by one decision made at age 25 and repeated consistently for 3 decades. You contributed $180,000 of your own money. The market contributed $387,000. For every dollar you invested, the market added approximately $2.15 beyond your original contribution. This is not a marketing claim. It is the result of long-term arithmetic applied to historically average returns over a sufficiently long time horizon. Compounding was given time to do what it does best. You are now 55 years old. This account is not your only asset. You have home equity. You have a 401k. Built through decades of salary deferrals and employer contributions. You have a separate brokerage account funded in years when your income allowed additional investing. The original $500 per month account is only one pillar. But it is one of the pillars that helped create what others would describe as financial security. From the outside, it appears substantial. From the inside, it looks much simpler. 30 years of one modest decision repeated without interruption. You think about the person you were at 25. Sitting in front of an investing app. Feeling a quiet anxiety about making a mistake. That person did one thing correctly. Not a perfect thing. Not the most sophisticated thing. A consistent thing. Consistency created the result. Not the contribution amount alone. Not market timing. Not selecting the perfect fund, though low-cost diversified investing mattered. What mattered most was maintaining the habit across decades. That is what transformed $180,000 of contributions into $567,000. Somewhere, a 25-year-old is looking at a bank balance right now. There is $500 in the account that has not yet been assigned. It arrived this week. No decision has been made. In the next few days, or perhaps in the next few hours, that person will decide whether the money becomes an asset or becomes another ordinary expense. Nothing dramatic. A dinner out. A short trip. A purchase that will be forgotten before the year ends. What they do not yet realize is that this is not merely a $500 decision. It is a $387,000 decision. Because that is what consistent investing, patience, and time can add beyond the money they contribute themselves. The $500 is not the central point. The decision is. The decision to treat one portion of income differently than they ever have before. To move it before it is spent. To automate it before the month provides a reason to postpone. To begin before they feel fully prepared. Readiness is not the prerequisite. Readiness is the reward that arrives years later, after the habit has already done its work. The mathematics are indifferent to your emotions. Compounding does not require certainty. It requires consistency. Start before you feel ready. The next 30 years will pass whether you invest or not. The only question is what will be waiting in the account when you arrive.